Now we can start to record. Alrighty, super. Okay, so here we're now revising, as you guys knew, we're revising the replacement test. Okay, so with the replacement test, what did they ask? Okay, what did they ask? So I think let's start with question 3 and work our way backwards. Okay, so in question 3, they said prepare the journal entries on 31 January 2021 to record the adjustments detailed above. All right, journal narrations are required. Okay, and then they say show all workings, and then they say ignore that. Right, so here, let me actually get this pen of mine ready. It's probably going to need it. All right. So here they say below is the pre-adjustment trial balance of Jasmine General Dealers for the year ended 31 July 2021. Okay. Additional information at 31 January 2021. Okay. Which is our year end. They say stationery on hand 720. Okay, so that means we have to adjust our stationery downwards. Remember, we're doing the general journal here, okay? Not the trial balance we were doing in the last session. So here now you can see we're actually dealing with the adjustment. So here you can see stationery on hand. This should actually be consumable stores on hand. Yes, this should be consumable stores on hand, my bad. Consumable stores on hand. Okay, we're debiting that's a current asset. Okay, so that's increasing. Then obviously stationary expense, we're crediting it because it's decreasing. Then under the narration, we just say stationary adjustment for stationary on hand. All right, you can also say adjustment of stationary expense. Okay, rent expense of 1,000 per month is incurred for 12 months to January 31. Jasmine General Dealers has been renting the premises from 1 February 2020. Okay, so February 2020, March, April, May, June, July, August, September, October, November, December, January, right? So that is 12 months. Okay, so then we say, okay, that should then be 12,000. If you look at rent expense, you see that it is 12,000. So there's no adjustment we need to do there. Okay, we were just wasting our time. All right. Then the next one, they say equipment was purchased on 1 February 2020. So I know the moment they mention an asset, there's going to need to be a depreciation calculation. So it was bought 1 February 2020. Okay. Let's double check. Am I recording? I'm recording. Okay. All right. And is expected to be used for 2 years, after which it could be sold for 3,000 residual value. The straight line method of depreciation is used. Okay, so basically what are they letting us know? Okay, and we are looking at the year end of 31 January 2021. So that's full 12 months. 12 months. Okay, so they say it is expected to be used for 2 years, after which it can be sold for 3,000. So, can you see they didn't give us the depreciation rate here? How much did they say that the stationery is worth? The equipment. We have to look at our table, and we see it's 12,000. Okay. Right, and if we look at our information, I know you guys don't have it in front of you. This is all the information they said in relation to equipment. So then what we're saying is, they're saying the next year again, 31 1 2022, right? So let me change colors over there to your screen. That's the second year. Okay. So they say it is expected to be used for 2 years, after which it can be sold for 3,000. So at this point, because this is year 1, isn't? And this is year 2, right? This is now, it can now be sold for 3,000. Okay, I'm doing all of this to show you how much does it depreciate by, in order to, by the time it gets to this. So we then have to say 12,000 minus 3,000. What do we get? 9,000. Right? 9,000 then divided by 2, we get 4,500, isn't it? So in years, it depreciates by, let me change colors, 4,500. 4,500. Okay, but we're again only interested in this year here, this period in blue, isn't it? Okay, so we can then come here and we say, okay, cool, depreciation on equipment. Okay, well here they've bulked it up. So anyway, here's your accumulated depreciation, because remember, depreciation and then accumulated depreciation. So there's your 4.5. Okay, so we'll come back to this because clearly there's also depreciation on furniture. Okay, but I was just showing you how you calculate the depreciation. So here, can you see we didn't actually even use interest rates? Right. So they can ask you this in different ways. This was a very smart. I've seen this in another exercise or past paper somewhere. Can't remember, but we did it together. It's in one of the videos. In the normal test. Maybe that's where I saw it, because I remember us doing it this year. Okay. Anyway, so let's go on. So I think, yeah, you have to have a good understanding of of depreciation. All right. Anyway, the furniture was purchased on 1 February 2020. Okay, so that's pretty much the same timelines, but I'll use gray this time. 1 February 2020. I'll just put 20. Okay, it depreciates at 20% per annum using the diminishing balance method. Oh no, we have an extra step. Okay, we know this is until January 2022. 2021, sorry, my bad. That's the financial year 1. Okay, right. All right, that's all the information they gave. So we then look at our pre-adjustment trial balance. Furniture is 7,500. Okay, do we have any accumulated depreciation? No, we don't. Okay, so, but again, since it was just purchased just a year ago, then there is no accumulated depreciation. We're then assuming all the 750 was purchased then. Okay, so we then say, okay, cool. So basically, it's like straight line. We were just saying 7,500 times 12 over 12. This is a full year times 0. And what do we get? 1.5. Okay, cool. So we get 1.5, which is consistent with what over here. Okay, so 1.5. All right, and I think that's all the depreciation we have. Okay, the accumulated depreciation on furniture also 1.5. Okay, right. So then let's continue. They say the loan for Time Bank was received on 1 January 2021. Okay, so we've only had it for a month, because remember our year end is 1 January 2021. Okay, interest on the loan is 15% per annum, accrues monthly. Okay, all right. So then we're saying, let's look at what is the total on our loan. Loan from Time Bank. Okay, it says in brackets repayable in 2024, but we're not interested in that because we're dealing with 2021 January financial year. And so 20,000, then times what's the interest rate? Did we say? We said it's 1 month, 1 over 12, times the interest rate of 15%, which gives us what? 250. 250. Yep. And that's exactly what we get. So obviously interest on loan expense or interest expense is going to be debited because it's increasing, it's an expense. Then your accrued expense is obviously increasing because what does it say here? Or if you look at your pre-adjustment trial balance, we do not have an interest expense. Okay, so it hasn't been accounted. That's why the other account that's affected is accrued expense because basically it means we haven't paid it. Okay, then you obviously are just saying adjustment to accrued expense. Sorry, interest accrued. Okay, you could also just say adjustment to interest expense. Okay, or interest on loan expense. Okay, but just keep it short. Just keep it short. All right. Then the next one, a debtor owes the business 4,500 and they have been declared insolvent. Okay. It has therefore been decided to write off this amount as irrecoverable. Okay, so the whole 4,500 we're writing off. So we know, as you can see there already, credit loss is going to decrease, is going to increase. We're going to debit that. Okay, 4,500. Fortunately, they didn't say we paid 50 cents, we were paid 50 cents on the dollar or anything funny like that. It's a straight 4,500 that must be written off. And then obviously debtors control is going to decrease. There you can just say credit loss is written off. Okay, bad debts written off. That would also work. Then last one, they said after analyzing the debtor's age analysis at the year end 31 January 2021, Jasmine General Dealers believes that an allowance for credit losses of 330 should be recognized. Should be recognized. Then we look immediately in our adjustments, sorry, in our pre-adjustment trial balance, in our pre-adjustment trial balance, we check. Do we already have an allowance for credit losses? In the balance sheet section, no, we do not. All right. So this is not an adjustment, it's actually the creation of an allowance. Okay, because it doesn't exist currently. So your allowance for credit losses adjustment, which we know is an expense, is going to be debited, okay, which we've done. And then your allowance for credit losses, which we know is a negative asset, is going to be credited. All right, and there you have allowance for credit losses created. Okay, can you see again? This time they didn't tell you that you need to create it. They just said it needs to be recognized. Okay, so I know when we did our papers yesterday, I did make mention of that, and it's good to see you actually now have a practical example of it. So that was your question 3, which was a total of 25 marks already. So you're already at like half of the paper if you manage to get that done. Okay, then here obviously have your general ledger with question 2. Okay, so here it says the following balances appeared in the books of IV Ltd on 31 December. All right, but before we get there, it says prepare the following general ledger accounts. Asset disposal on the 1st of January. Asset disposal on the 1st of January 21. All right, they want the asset disposal. So in other words, we obviously sold something. We obviously sold something. Then they also want the vehicles on the 31st of December 2021. Okay, right. A folio column is not required. Okay, so we can ignore folio. Calculate the depreciation expense. This is part B now. Calculate the depreciation expense for vehicles on the 31st of December 2021. Round to 2 decimal place. Okay. So the following balances appear in the books of IV Ltd 31 December 2020. Okay, so these are going to be our opening balances. So here for vehicles, this is obviously going to be a debit balance, so balance. Okay, so they did say ignore folio. Okay, but let me at least do it for this one, and that's 448,000. Okay, right, and then obviously for accumulated depreciation on vehicles is 212,000. So I'm just gonna say AD over here, 210,784, because we're gonna need that, and this is at 31 December 2020. Okay. Right, then it goes on to say a vehicle with a carrying value of 57,792 Rand was traded in on a new vehicle bought from NA Motors on 1 January 2021. Okay, so I think it's best to do our timeline. So here we bought, or actually, let me say traded in. Okay, so T for traded in. All right. The purchase price of the new vehicle was 200 and so the trade in, let me put this 57, because this is the carrying value 92, and then just put CV for carrying value here, and then the value of the purchase price of the new vehicle is 268,800. Okay, and the trade-in covered 62, so it covered, so let me actually do it like this rather. Let me put CV here, because that's the carrying value, and then put T for the trade-in value, which was, so this vehicle, although its carrying value is 57, it covered 62,720. All right, so we have that bit. The balance was paid in cash. Okay, the balance was paid in cash. All right, so in other words, we don't have a creditor as a result. All right, very important. So whatever the difference is, it's going to affect the bank. Okay, balance was paid in cash. Does that make sense? Okay. Right, so we have all that information there. The balance of the vehicles account on 31 December 2021 was 537,600, and no further vehicles were bought or sold during the year. Okay, so they're basically saying, remember this is 1 January, at the end of financial year, which is now then your 31 December 21, we're saying vehicles, the balance there is 537,600. Okay. Depreciation on vehicles, 15% using the diminishing balance method. 15% diminishing balance. Okay, method. The financial year end is 31 December. Okay, that we know. Okay, so now we can obviously disposal. Okay, in order to do this, we need to know. We need to know. I just want to see something quickly. Sorry, this 480 is for, I just want to put in the date. There you go. And that is 31/12/20, right? Okay. Then we know the very next day what happened. We bought a vehicle. All right. In other words, we traded in a vehicle. So here, well, we also sold one. So maybe let's record the disposal first. Okay. Now we know the disposal, they haven't given us what the actual value of the vehicle was. Can you see that? They just gave us the carrying value. All right. But we can easily work that out. How can we work that out? Okay, I can see it on your faces. You guys are tired, so I'm going to give it to you. Cost price is equals to V is equals to what? CV, yes, plus, that's it, accumulated depreciation. Okay, right? We know this because I've just played around with the formula. Let me show you what formula I played around with, because this I know you're familiar with. CV is equals to cost price minus accumulated depreciation. Yeah, you guys know this, and I can see you nodding your head. Okay, so I just played around with that to get the cost price. So we say, okay, the cost price. Let's actually first calculate. Oh, I'll do it here. So we're saying the carrying value is 57,792, and then plus the accumulated depreciation of 210,784. What do we get? We get the 260. So here, remember, this is going to your asset disposal. Remember, step number one, according to your, is to remove accumulated depreciation. So here you're going to say asset, sorry, remove the cost price of the asset. I think we're all tired. Asset disposal. Thank goodness today is the last day. Yeah, I'm finished. Okay, so here 268,576. Right. I've just recorded this. I might as well record. Let me just write down the steps here quickly. Fortunately, this is not a midway disposal, so we can use the regular steps. So let me use a different color in blue. One, we need to remove the cost price of the asset we disposed. Okay, remove cost price. Two, we need to remove accumulated depreciation. Three, we need to record the sale. Four, we need to do what? Find out if we made a profit or loss on the sale. Is there anything else we need to do? That's it. Okay. So we can then come, and if we're crediting vehicles, that means we're obviously debiting your asset disposal. So we're kind of doing this concurrently. Okay. And remember, this happened when? On the 1st of January 2021. Okay. So here we go, vehicles. Okay. And here we're saying 268,576. Done. Okay, step number one. Then step number two, we said we're removing accumulated depreciation. And this accumulated depreciation, we said, was on the 210. That was on December, 30 December. 30 December. So that's the day before. Okay, so we can take that as the accumulated depreciation. That's not a problem. Okay, we're removing accumulated depreciation from the books. So we know accumulated depreciation, whenever it takes place, are we debiting or crediting? We're crediting. Okay, so now if we're removing it from the books, what are we going to do to accumulated depreciation? We're going to debit. So in the asset disposal account, we're going to credit the asset disposal account. Does it make sense? Since we debited in the accumulated depreciation, here we're going to credit. Okay, so here we're going to have accumulated depreciation. I'm just going to say dip. And then obviously this is on vehicles. Okay. And there we're using the 210,784. Okay. Right. Then the next thing we need to do, according is record the sale. Okay. So we can either continue on this process of recording the disposal, which is the first bit, or we can then continue doing the vehicles account. Okay, but I would just stick to finishing off one. So I would want to finish off just recording the disposal. That's what I would do. Okay, just to make my life easier, because then I'm constantly in two minds. Does that make sense? Which makes it easy for me to make a mistake along the way. So we've removed the accumulated depreciation. We're now on record the sale. Okay, so we know that this was a trade in, isn't it? So how are we going to then record this? How are we going to record this? We're going to do what? No, we don't owe anybody. Remember, we did the balance for cash. We traded it in. Remember, that was what we did. That was how we disposed of the asset. So you have to ask yourself, how did we dispose? Because remember, we're reporting the sale. So if we had sold it for cash, we would have said bank. If we had sold it on credit, we would have said debtors control. Okay. And here, in a sense, we actually have sold it for cash, so to speak. Okay. But we need to record the sale on the trade-in value. Does that make sense? Because that was our selling price in a sense. Okay. So we would then take 62, because that's the value that we got for disposing of it. Does that make sense? Okay. So we come here, and that we are going to credit. Okay. We're going to credit that, and here we're going to actually say bank. Okay, and we're going to say, in brackets, I'm just doing this for our clarity, trade in, close brackets. Okay, but you don't need to do this. Okay, and then put the 62. Sorry, you guys can see clearly, right? 62, 7, 20. Okay, right. So obviously the other account that's affected is bank. Okay, but now because we did not actually, they didn't ask us to do the bank account, we're obviously not going to do that double entry. Does that make sense? So we're actually done with step number 3, recording the sale. Okay. The next thing we now need to find out is, did we make a profit on the sale of this vehicle? Sorry, say it again. That no, it doesn't. We record that where? In the bank. No. That's going to affect bank, and it's going to affect your vehicles. Because remember, the vehicles, our assets are increasing to the value of the asset that we purchased. It's not a part of the disposal. The disposal, remember, asset is clicking. The asset disposal is, we're recording the disposal of this asset. Is that not part of the disposal? It's not part of the disposal. Yeah, that paying of cash is going to go off the bank account. It's going to increase our asset, that being vehicle. I can totally understand why you're thinking it should affect asset disposal, but remember, asset disposal is strictly about the disposal of the asset that we have. It's not about the asset that's now coming in. Does that make sense? Because the balance, why are we paying that additional amount? Because we're buying a new asset. Making sense now? Super. Okay, right. So then I just want to see something. Sorry, the asset disposal. Remember, this was the removal of the. I made a mistake here. This was supposed to be the removal of the old asset. And what was the value of the old asset? We said it is going to be your carrying value plus the accumulated depreciation. And the accumulated, so that's what we calculated over there. So how come we're not getting the same thing here? Just give me a quick second. Okay. I just want to see. We bought the new vehicle on the 1st. Accumulated depreciation that they gave us was up until the 31st of December. Yeah. So that means yeah, I think this is correct. Yeah. This should be correct because we want to know the carrying value of the vehicle sold was, but they did not. When did they tell us when we bought this? When we first bought this, they did not tell us. Here what we do, added 210 to the carrying value, and the carrying value was 57. Yeah, so we should have. Yeah, I envision that to be. Yeah, no, I think we've done the right thing there. Okay, sorry, I was just having a moment there by myself. Mhm. Okay. Right, so trade in, there we have it. It's the 62. Right, so number 3, then we need to record whether we made a profit or a loss on the sale of the vehicle. How do we do that? We say carrying value minus your selling price. Okay, so here, if we check, we see that our selling price was the 60. How much we have it? 62,720. That was how much we sold it for. 62,720. 720. And the carrying value was this 57,792, which then gives us what? What's the difference there? Okay, so we obviously made a profit. In 28. Okay, so we're happy with that. And so obviously, you're going to then have profit on trading. Are we going to debit or credit that amount? Are we going to debit or credit that amount? Are you sure? To the asset disposal? We're going to credit, we're going to debit that amount. Okay, so here you're going to say profit on trade-in. Okay, because it's not a sale. Okay, but I know we're used to profit on sale. Okay, or loss on sale. And we said that was 4,000. How much? 982. 928. Okay. Right. Okay. Then that's that. And then what else needs to be done over here? That's pretty much it. Those are our 4 steps. Then what you're supposed to get on your debit side should match what you get on your credit side. And then you know you are home and dry. Okay. So I'm just going to leave that there. I don't know if you guys want to add it up. It's fine if you want to add it up, just to double check. But then on this side, remember we still need to do the vehicles. So remember we still have to record having purchased the vehicle, right? So here on 1 January, right? 21, we did buy the vehicle, okay? And we bought that for cash, bank, okay? So then we then ask ourselves, okay, how much are we plugging in there? What's the value of the vehicle? Okay, so the value of our vehicle was then this 268,800. Okay, that was the value of the new vehicle. So our vehicles account is increasing by that amount, 268,800. Okay, are there any other transactions that would have affected the vehicle account? Anything else that would have affected the vehicle account? I think we will check that at a later point to see if we do. But no, I don't think we have to do that. No, it doesn't look like we have to, but we'll check. We'll check. We just have to double check. But the second bit, they did say something about depreciation, so we'll quickly check that now. So there's nothing else in relation to vehicles. That's it, because we sold one, disposed of one, we bought one, and we obviously had the opening balance. So then obviously now we just need to quickly calculate what is our balances. Okay, so this is obviously the bigger side, and I'll just give you the answer now. This is what total that you should get. Sorry, 8. Okay, just gonna copy and paste this on this side, paste it here. We obviously have a debit balance, okay, which is a good thing. And they gave us the balance, remember, within the question. So if you check, the balance is the difference between this side and the smaller side and this side. Okay, let me just copy and paste here. Okay, we should get the 537, which they gave us, 537, 600. Okay, I'm just gonna copy and paste that. You don't get this, the difference between the smaller and the bigger side. Okay, so what are you actually getting? 44822. Wait, as the balance, the difference between the two. Ah, I see what they've then done here. So then what we've done is, remember how we calculated the value of this asset that we disposed of? This amount here, 280. We said carrying value plus the depreciation on the, sorry, carrying value plus the accumulated depreciation. Okay, so the thing about that is we don't know. This was a rookie mistake. We don't know if all the vehicles pertain to this one vehicle that was disposed of. Does that make sense? So we actually needed to actually work our way backwards. We've actually done it the other way around. So what we then need to do is this needs to be the balance that we need to calculate, and this is why they gave us the vehicles balance. Does it make sense? So let me do it like this, so you guys can see what I'm saying. I want to make sure. So we need to work out backwards, way backwards, say what was the value that we need to take out of the vehicles account pertaining to the vehicle we disposed of on the first. So we then say, okay, cool. If the total of the bigger side is 716. Actually, let me just, so we can calculate it here, right? Then, and we know that the balance, right? In other words, the difference between the smaller and the bigger side is this 537, right? 37. Oh, 6, 5, 37, 600. That then means that the value of the vehicle is actually 178, 400. Eight way? Oh, and oh, okay. All right, so this is obviously going to change. Equals. Oh, it's been a long day. Okay, all right. I just want this to all be like in one thing. So let me do this. You don't need this anymore. I want to stretch this here. Okay, it's not allowing me. Okay, but anyway, it's fine. It's fine. I just want this, at least this should be in one line for you guys. And let's just do this to make it neater. Okay, it's not allowing me to be great. Let's just do this. Right, okay. I do this. Cool. So here we should have 179,200. Okay, which then obviously means that over here for our cost, that should also be the same thing when we copy and paste. Because remember, they never gave us our cost, isn't it? We had to work it out. Just one good amount. Oh, okay, that's not happening. Write it up. 179,200. Okay. So, well, we didn't actually work out our balances here. But remember again, so here that means that if this was our cost, remember we're working on the reducing balance method. That means that this accumulated depreciation is not all going to belong to this one asset. So we're going to actually have to work it out. So this was your question, Mary. Do we need to work this out? So what then happens? So it looks like we are going to have to do exactly that. All right. Oh, actually, we won't. We'll just need to do this calculation. Remember, we've got the carrying value of the asset we disposed of. So which is this here. Which is this here. So now that we have the accumulated depreciation, the cost price, we're simply going to say 179,200 minus the cost of the 7, how much? 792. 792. What do we get in terms of accumulated depreciation? This is, remember, carrying value. This is your cost price to get our accumulated depreciation on the asset we disposed. Make sense? What do we have? 121,408. 408. Okay, that's fine. Exactly what we should have. Okay. Last point of reference to see, did we do the right thing? Is remember your debit and your credit must equal each other. Because remember your asset disposal is a temporary account. Okay, so 121 408. Are they the same? Are they the same? Actually, I also don't need this one. We have the same total on both sides. We don't. How is that possible? You're saying this should be 428. Okay, let me do it. You get the 48. All right, so let's then calculate this together. We're then saying, no, man, but it should be. So we're then saying 121 408 plus 2 720. Okay, and then here, okay, so here again 179 200 plus, which it's such a relief you're saying they're even, because the would also be perplexed as to what's going on. Okay, so okay, we're happy then, ne? It's working. All right. So it doesn't have to resign. Okay. Right, and then obviously I'm just going to remove this here. All right, all right. So we know, okay, we have dealt with the asset disposal. We've also dealt with the vehicles account. Okay, so let's quickly see what they're asking for in B, and then guys, we can take a quick break, or we can quickly just have a look at the theory, because the theory, if you look, it's already there. So I'll tell you what they were asking there, and then we'll call it a day. It's up to you. Okay, so part B, what were they asking in part B? What were they asking in part B? Calculate the depreciation expense for the vehicles on 31 December 2021. Okay, so how do we calculate the depreciation? Because remember, this disposal happened on the 1st of January 2021. So now they're asking for the at the end of the financial year. Okay, so I'm looking for a nice place to write, and I don't think there is one. But basically, we have to ask ourselves the following question: what assets what vehicles do we have after this disposal? Okay, we know that if we look at the our vehicles account at the beginning, well, this is going to be closed off. We did add the vehicle that we added. So this balance brought down is a reflection of the vehicles that we have at the end of the year. Does that make sense? So we can actually, we don't need to calculate anything. We can just take that 5. What's going on? Behave yourself. 5, how much is it? 537 600. And let's just go back to our question. Because they did say the balance of the vehicles account on 31 December 2021 was 537 600. So we can be confident this is the value of our vehicles at the end of the financial year, which was, they said there was no addition or disposal, all right, after this, okay? So therefore, we can be confident, okay, this is the balance we should have after the disposal and after the addition. Okay. So anyway, so then we wanted 15%, but then remember this is on the diminishing balance method. Okay. Right. So that's we've had the both of these assets for the full year, but remember also again, we may have accumulated depreciation for the old assets. Let me say it like this. Okay, the new asset, we have to separate new depreciation for the new asset and then on all the other old vehicles that we still have. Okay, so the new, let me start with the new because the new is easiest because there's no accumulated depreciation there. That's going to be for the total amount of the 268,800, okay, which is also posted in the vehicle account over there. Okay. Right. So times 12 over 12, then times your 15%. There's no accumulated depreciation there because it's brand new. So what is the depreciation on that? Then we know all our old is basically going to be minus this 268,800. Okay. This is for the old. Do we have, what is it? 40320. Okay. No, it's fine. Okay, so we have that. Okay, this is again for the new. Let me change colors here as you continue. So this is the cost price of the old. Remember, we need now to minus accumulated depreciation because we are on the reducing balance method. So we know that on the 31st, which is here, of December, because this is the first of 2021. We know that the accumulated depreciation up until that point, the day before, is 210, right? 210, 784. Okay, but in that 210, 784 is also inclusive of the asset we disposed of on the first. Does that make sense? So we now need to remove that depreciation. So for us to get the accumulated depreciation only for the old, we then say 210, sorry, 784, all right, minus the accumulated. Fortunately, we have already calculated when we were disposing of the asset. That's now the 121,408. 121,408. Okay, right. And then, okay, so let's get the totals. I'm going to write this in red. Let's get the totals of the cost price of all the old. What do we have? Yes. Yes. So if we look, I'm so glad you asked that question. If we look here, can you see, according to our vehicles, can you see the 537,600 is the closing balance on our vehicles account? After we have actually removed, can you see that? The vehicle that we disposed of. So that is definitely exclusive of that. Hmm. Okay. We have to minus that too. We have to minus that too. So what we're removing is literally just the new vehicle. Okay, super. So what is the difference that we get from this first set of brackets? 268,800. Really? It is actually that. Okay, super. All right. So that's the value of the old vehicles. Then minus the accumulated depreciation. What do we have? 002 72. Okay. 377. Okay. Let's see. Let's verify. Is what? 376. Okay, super. Okay, so this now, these two, because this is the cost price, this is the accumulated depreciation on the old vehicles, that's going to give us our carrying value. And then we're going to times that by the depreciation rate of 15% to find out the depreciation on the old. So what do we get once we say times 15%? Okay. Okay, so I'm just going to put this up here because we want to add it to find out total depreciation with the new. So you said how much? 913.6. Okay, super. And they did say to do decimal place, by the way, so that's good. All right, so we're adding those two to get now our total depreciation for this year on our vehicles account. So that should be 67. Yes, you're right. How much? 233.6. Okay, and that is your answer. Because they just said in the question, they just asked you to calculate. I don't think they didn't ask us to. Let's see. They didn't ask us to actually like record it. They said calculate the depreciation expense. Yes, for the vehicles on 31 December. Okay, so this is your final answer for the second part. All right. So thank you for bearing with me there. I know you guys are tired. So question 1. Do you want to just quickly gloss over it, or do you want to take a quick 5 minutes? Quickly gloss over it and call it a day. Okay. So question 1, they gave you column A, and then you obviously needed to give the journal or the book or the thing that best describes. So column B was blank. Okay, but I've obviously just added in the things that I think you should have thrown in there. So the journal in which depreciation is recorded, general journal, we know. All adjustments, errors, corrected in the general journal. The account to be credited when creating an allowance for credit losses, allowance for credit losses. When creating, you see they actually told you when we're creating, because if they said, if we're adjusting, it can go either way. Okay, so, yes. I believe so. What were you writing? Huh? I believe so. It's familiar. Yeah, but I told you we're doing the replacement. It was rough. Mhm. So number 3, they say also known as the reducing balance method of calculating depreciation. So that's diminishing balance method, okay? Number 4, an expense incurred in the current financial year, but only paid in the next financial year, okay? This is an accrued expense, okay? We owe it. We should have paid it last year, but we weren't paying it in future because we haven't paid it on the before the final day or on the final day. Okay, because remember when we're doing our adjustments, we'll be saying this is yet to be paid or this hasn't been paid yet. Okay, then next one, the trial balance prepared after closing entries have been recorded. Okay, so this is now the post adjustment trial balance, which is what we were working with in the last session that we were together. Then lastly, an amount owing to the entity that cannot be paid by the debtor and needs to be written off. Okay, the moment you see written off, I'm sure you know. Credit losses or bad debts. We throw that S on there. Okay. And then the last thing they said, explain what you understand in your own words. All right. Post adjustment trial balance. What is that? Okay. I think you guys should be able to do that. Depreciation amount. Oh, sorry, depreciable amount. Okay, what is that? Okay, how would you describe that? Then the last bit, what did they ask you? All right, traders received the January rental income for 30 December. The financial year end is 31 December. Name the relevant accounting principle or concept to be applied and explain when the income should be recorded and why. So here we're talking about the accrual concept. And this is accrual income to be specific. And we will then go on to explain how this is money that we have earned but haven't yet been paid. It is due to us, but we have not received it. Okay? So that's pretty much what you'll be talking to there. Okay, that's all. Okay, so guys, my advice from the theory side of things: make sure you're comfortable with bank record, theory-wise. Make sure you're comfortable with creditors and debtors record. Make sure you're comfortable with explaining the accrual concept, also things on depreciation. Okay, because they tested you guys on this stuff and adjustments as well, which is speaking to the whole accrual and stuff like that. Because they've tested you on the stuff in the test and in the assignment, so they would want to reserve your exam for things they haven't yet tested. So those things that we did earlier in terms of changing the interest for a CC, definitely coming in one way, shape, or form. The stuff we did in terms of partnerships, definitely coming because they haven't tested you on that. The stuff we did in Unit 7, very important. They've been asking it a whole lot more in the recent years, so please make sure you go and practice that. Build your structure. How do I approach these questions? How do I tackle these questions? How do I put together the information? And yeah, I think that you guys should be fine. Yes. Yes.